Welcome to Bloomberg ETF IQ Europe. I'm Francine Lacqua, and over the next 30 minutes, we'll be your guide to the region's thriving market in exchange-traded funds. Everything you need to know about the funds and the flows. A volatile month. September ends with net flows into Europe's ETFs, but at the slowest rate in 6 months. We'll discuss what's hot as 2020's fourth quarter gets underway. Junk sells off as investors pull money from high-yield debt. We'll ask what innovations we'll see in the region's bond ETF market. And going synthetic, the world's largest asset manager launches its first swap-based equity ETF. We'll speak to BlackRock's head of iShares for EMEA. Let's get straight to our Danny Berger with what to watch for the rest of the day.
Good morning, Francine. Up on the board for you, I have FFLO Go. So this is your view into the biggest moves when it comes to the ETF market. So I'm looking at basically which regions got the most flows. So ETFs tracking different regions. And I'm looking over the past month since we've seen September wrap up. Now, in total, European ETFs had net inflows at exactly 424 million US dollars. But Francine, that's led by just one thing. And that one thing is flows into Switzerland. Switzerland tracking ETFs, getting nearly $400 million of inflows. Now, part of what that is, you have to imagine, is what's happening with the Swiss franc. The Swiss National Bank spending 90 billion franc on helping to prop up the currency. Now, what that might mean is it makes Swiss assets more attractive. The Swiss stock market certainly outperforming its other European peers, but it also might be a similar effect to what's going on in some of the other regions. For example, like Denmark, Italy, when you have the euro or the Swiss franc strengthening against your home currency, it might make it more attractive to jump in, because once you sell off that ETF and get your original currency back, you'll get more bang for your buck. Now, looking on the bottom there, we have Spain with $64 million worth of outflows. Interesting story there, because we had a lot of big M&A news in the Spanish banking sector over the past month, but that wasn't enough to attract investors in there. Perhaps the lack of dividends from banks, of course, banks very heavy in the Spanish equity sector, means that investors were moving away from there. And I should say this month was a weird one to invest. A lot of the movers, a lot of the gains we saw, at least for equity markets, had to do with various deal flow. And if you're an ETF investor, it can be extremely hard, if not impossible, to capture that deal flow, because, of course, you're investing in an index, not individual companies. So a little bit all over the place. Perhaps it was just a month of stock picking, Francine.
Danny, thank you so much. Now joining us to talk about all of this, the funds and the flows, and exactly what we see in the markets, joining us is Stephen Cohen, head of iShares for EMEA at BlackRock. Stephen, great to have you on the program. How do you see this market evolving from now until the mid-2021?
Yeah, look, I think we've had an incredible 6 months. I think it's important to go back to where we were in March, April. We had pretty much record outflows from much of the ETF industry, particularly in fixed income. And over the last 6 months, we've seen that really not just turn around, but accelerate. As you mentioned, as you said on the opening of the show, it's tailed off a little bit over the last month. I think that's to be expected. Firstly, because investors have put a lot of money back into the market, and secondly, because I think when we look out over the next 3 to 6 months, and particularly the next 3 months, there are a lot of sources of uncertainty. Clearly, we have the US election, which is, I think, probably the biggest source of uncertainty. But we also have this kind of re-rise of infection rates in much of Europe, particularly here in the UK, which is causing investors to be a little bit nervous in terms of what does that mean for what has been a pretty, impressive and positive recovery thus far. So I think that the next quarter, I think we expect more volatility. We do expect to continue to see some of the flows trends that we've seen up until now. I think China has been an area of a lot of focus, particularly China bonds, given the yield pickup there, China equities as well. I think on a more structural basis, when you look into 2021, the big trends that we've seen over the last 6 months, and actually beyond that, remain very much in place. We are seeing a structural shift into sustainable investing, and we're seeing that very much in the ETF market. And we are seeing this continued acceleration of adoption of fixed income. And actually, I think that's a big catalyst from what we saw in the spring.
Stephen, if you are to protect yourself in terms of what you see for the U.S. elections, what kind of ETFs do you buy?
So we've definitely seen. So I mean, the great thing about ETFs is there's a pretty wide spread of options that are out there, and I think that clearly the first thing we've seen a little bit of risk off demand. So we've seen some, as you mentioned earlier on, some selling out of high yield and buying of rates, a government bond product, and that has been a trend over the last 2 to 3 weeks. We continue to see interest in quality, and I think that is something as a firm we continue to believe in. I mean, irrespective of the specific outcome of the election, I think in an uncertain environment where you still have this backdrop of coronavirus, strong balance sheets is going to be very, very important. So those are two areas, and I think that we believe that we've moved into a new, or we're moving into a new paradigm of inflation. That medium-term inflation will be higher than what we have expected coming into coronavirus. And again, I think that one of the things that we'll see as part of the election is actually, this potential for even more stimulus. And if you do see that in many areas, then actually inflation expectations and inflation ETFs remain an interesting area, given where we're currently pricing the market.
All right, thanks so much. Stephen Cohen there from BlackRock stays with us. Now, coming up, the world's largest asset manager launches its first synthetic equity ETF, relying on swaps rather than owning the underlying stocks. But why would you want one? We'll bring that up next. This is Bloomberg. This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now, BlackRock has this week launched its first synthetic equity exchange-traded fund. The iShares S&P 500 swap ETF will rely on derivatives rather than owning the underlying stocks. Well, Europe's biggest issuer has until now resisted the move. Now, we'll get the thoughts, of course, of the company's head of iShares in Europe in a moment. But first, with the story is Athanasios Psorafagis from Bloomberg Intelligence. Athanasios, explain how this works and actually what the advantages are.
Sure. Good morning, Francine. So synthetics, they're not as a big a part of the industry as they used to be. They're about 15% of the total assets. But in some areas, particularly U.S. exposure, there is a synthetic advantage. And it all really comes down to taxes. With the physically replicating ETFs, there's a withholding tax on dividends, anywhere ranging from 15 to 30%, depending where the product is domiciled. Synthetics are actually, because of the tax code, able to bypass tax withholding. So there's a big tax advantage by owning the synthetic, because there's a little bit of tax drag when you own the physical. So this is really one of the main drivers why we've seen some of these synthetic products actually do really well recently. Over the last year or so, you're seeing more inflows into the synthetic S&P 500 products at the expense of the physicals. That being said, there are already S&P synthetic products on the market. Most of the large issuers already have a lineup, Invesco, DWS, Lixor, et cetera. And in fact, if you look at Invesco's S&P synthetic product, it actually is in the top 10 assets of all products on the market. So clearly investors see the benefit of using a synthetic. They understand how it's structured, and it looks like there is a use case for some investor bases. So I expect this product actually to do pretty well from an asset gathering perspective.
Thank you so much, Athanasios Psorafagis there from Bloomberg Intelligence. Now, still with us, Stephen Cohen from BlackRock. Stephen, you took the plunge. Synthetic ETFs, here we come. Is it going to actually broaden and open up the market?
Yeah, I think that the way we looked at it is clearly. I mean, ETFs. This industry is all about innovation. It's all about evolution. And what we've seen, as was mentioned earlier on, is that there has been a growing demand over the last couple of years for a swap-based alternative to the physical funds, and that's what investors have come to us for. At the same time, and I think. More importantly, actually, is that over the last few years, there's been a real improvement in the ecosystem and an advancing of the ecosystem. And we've always said that there should be 3 criteria that investors should expect and should demand from any product, and particularly from these products. That there should be clear labeling. there should be greater transparency than there used to be around the way the products are structured and what's inside them. And finally, that there should be multiple independent counterparties, swap counterparties to any of these products. And that is where the industry has come to over the last couple of years. And that has really set up the opportunity to be able to provide investors what they are looking for, but with these standards that we think are incredibly important that investors should expect. It is very much focused, as was mentioned, on US equities, because that is where the demand is. And I think that's where the growth potential is, more so than a broad kind of opening up of swaps as an alternative to the broader physical range that we've obviously run and grown over the years.
But Stephen, do you see more demand for this kind of product? You know, will you be doing more in the coming quarters or years?
There's definitely demand. As I say, there's demand for this specific exposure. There is demand a little bit in what I would call the US equity space. That is really our focus. You know, beyond that, it's not something that we're focused on. I mean, beyond that, we remain very focused on building out our physical range, both in equities and obviously, you know, the biggest growth areas, which are fixed income ETFs and sustainable, which are the areas where we really believe will grow the ETF industry over the next kind of 4 to 5 years here in Europe.
Stephen, is there a catalyst to actually grow, you know, ESG ETFs more? Is it something that actually comes from outside the ETF space, or is it something in Europe that will mean that, you know, demand will significantly increase?
It's a great question. I think what we've seen this year is probably talk turned to action. There's a lot of discussion over the last couple of years around how do I transition to sustainable? What does it mean? How should I think about it? You know, we did a lot of work over the last couple of years in really setting out a range of products that had clarity. I think what investors are looking for is some clarity around what sustainable investing means to them, which means they need clarity and they need choice. And I think that's where the ETF industry can really play a huge role, in the indexing industry in general, which is actually around giving some standards for investors to be able to then make the right choice for them. That is starting to happen. Clearly, regulation plays a very, very significant role in this, and we're going to have to see how that plays out over the next 6 to 12 months. But it is the biggest, as I say, alongside fixed income, it is the area where we're seeing this catalyzation. I actually think the other thing that is happening is, as a result of the COVID crisis, I think many investors are looking at their portfolios in general and rethinking their portfolios in light of the changes in the macro environment. And that is going to accelerate their transition to sustainable as well. So the kind of combination of increased regulatory pressure, end investor demand, and I think the COVID crisis, coupled with, I think, what we have started to achieve within the ETF and indexing industry, which is really setting out some standards, giving investors some very clear choice that allows them to actually make that transition relatively cost efficiently. I think those are the things that are kind of catalyze sustainable investing as we look into 2021. And obviously this is going to be a massive trend for years to come.
Stephen, thanks so much. Stephen Cohen there from BlackRock stays with us. Now, we also, of course, have much more coming up. Which ETF attracted the most money this past week and which saw the strongest outflows? Our leaderboard is coming up shortly. Up next, we also talk about the future of fixed income. This is Bloomberg. This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now let's discuss the future of fixed income. Investors have been pulling money from high-yield bond ETFs after just 7 weeks in the green. The sell-off has pushed the Bloomberg Barclays Global High Yield Index to a loss for the year. That's as stock market gloom spreads to the riskier end of the credit market. Now, still with us, Stephen Cohen from BlackRock. Stephen, before we get to that, we're closing in on December 31st. How do you trade Brexit through ETFs?
Great question. I think Brexit is one of those uncertainty catalyzers that we talked about earlier on. I think in terms of, there are probably 2 ways to think about it. The first one is kind of the immediate, potential for volatility. And I think that, we see, people looking at kind of potential risk-off trades, like we said earlier on, around government bonds and things like that. I think the second thing is, how does it change your investment landscape on a longer-term basis? And that argues for more granular building blocks. And it argues for investors to think about, Europe ex-UK, the EU, the Eurozone. These are all different kind of parts of the broader European world, and clearly the UK and the European world as it stands today, that investors invest in, but I think are going to have to think differently. So I think we'll see more and more demand for those more granular building blocks over time, and thinking very, very distinctly around the kind of the fragmentation of the region and the UK versus the rest of Europe. In the immediate time, I think it's a cause of uncertainty, and I think it's going to cause investors to think more about the risk off and things like governments.
Stephen, we also wanted to talk about high-yield bond ETFs. I mean, there's quite a lot going on. I think like every 3 days there's a story about it. What do you think the real dynamics at play are?
Yeah, look, I think that there's always a good story that it gets a lot of headlines. I think you have to put some context around it. If you look since the end of March, when the Fed announced that high yield bonds would be part of, or high yield ETFs would be part of their program, we've had about $30 billion go into high yield ETFs globally. In the last 3-4 weeks, we've had about $5 billion come out. So that's less than 20% of what's come in the last 6 months. So I think we've also seen a huge spread tightening. And so, this market has had a great run. It is natural, given everything we've talked about over the next couple of next couple of months in terms of uncertainty, particularly in the US. And I think some of the concerns that are rising around coronavirus, and does that start to have an impact on some of the growth rebound that we've had, that investors, do some profit taking and take some risk off. I mean, our view is high yield still remains an attractive place to be, given the kind of lower forever rate environment we're now in, and the kind of implied default rates that you're seeing in there, and just the lack of yield, and the investors need income. So I personally think that this is something which is, first of all, in a high yield market, very much a what you would call kind of just a short term, very rational kind of profit taking. I also think again it shows the utility of bond ETFs, and what we've seen this year throughout the crisis, both in the sell-off and the rally, and now, is that ETFs are allowing people to make very quick adjustments to portfolios in these types of market conditions, and that is a growing a source of growth of demand for all types of investors in these products.
All right, Stephen, thanks so much. Stephen Cohen, we'll get back to Stephen in a second, but now let's also look at the week's winners and losers. Here's Danny Berger with your ETF leaderboard. Hi, Danny.
Hi, Francine. Well, these past 5 trading days, all about the Qs. That is the NASDAQ 100 ETF. Now, one version of it, listed in Italy, an Invesco one, got $400 million worth of inflows over the past week. That puts it at our #1 spot on the leaderboard. We have seen that big tech sector bounce off the bottom, so the dip buying continues unperturbed. Coming in at #2 there, that's Amundi's MSCI Emerging Market Fund that got $230 million worth of inflows over the past week. Interestingly, there could be a bit of a political tilt to this. For example, we heard from Goldman Sachs this week saying that a Joe Biden victory would actually be good for emerging markets. We've seen some of the betting markets start to price in an increased chance that he does indeed win the presidency after this week's debate, saying that higher taxes and better relations with Asia and other emerging market countries would be beneficial for the region. Invesco also saying that because China wasn't discussed in the debates, that's also a positive for emerging markets. Now, looking at the loser board, it is full of corporate bond ETFs. Investors fleeing credit. Francine, is similar to what you're talking with Stephen about, but here we're looking at investment grade getting sold off in Europe. As fate would have it, they are BlackRock iShares ETFs, both at #1 and #3 spot there. We have seen some of the spreads widening from a range that was set in July. Perhaps also some concern about the Fed taking their foot off the gas pedal when it comes to giving liquidity into the market. And finally, that #2 spot there, that's an Invesco commodity ETF. It tracks the Bloomberg Commodity Index. We did see the dollar sell off over the past 5 days, but prior to that, there were some indications that the dollar might strengthen. That could perhaps attribute to some of the sell off in those funds there, Francine.
Danny, thank you so much. Danny Berger there with the leaderboard. Let's get back to Stephen Cohen. Steve, when you look at some of the things that Danny was talking about, and if we focus, for example, on technology, there were also these new tech ETFs being proposed in China. What's the appetite like for European tech ETF products?
It is relatively high. I mean, I think that the two big themes that have come out of the last 6-7 months have been tech and healthcare. And if you look across BlackRock's platform, whether it's in our ETF business or in our active management business, our alpha business, tech and healthcare have been where we have seen the greatest demand, and that has continued through. Clearly, a lot of that is US-based in terms of kind of where the biggest access is for investors is the US. But I think that is going to broaden out. You mentioned China, Europe as a lesser so source of tech, but where I think that there is opportunities to invest in some of these themes, and technology is just one of them. We're definitely going to see demand. So I think the evolution of kind of these more thematic ETFs, which really do relate to these longer term trends, and technology just really fits across all of them, is something that we've definitely seen the last couple of months, the last 6 months. I think we'll continue to see that into 2021 as an area where investors do want to focus their portfolios.
Yeah, Stephen, how will healthcare ETFs actually change? As you know, there's a lot of focus, as you're saying, on this industry because of COVID-19 and vaccinations. Is there is there a country in Europe that gets it better than others, given our ETF market in Europe is so fragmented?
I think it's fairly broad in terms of there are potential players that fit inside a healthcare ETF or a healthcare index in multiple countries in Europe. So from an exposure standpoint, it really is quite pan-European. From an investor standpoint, that's kind of sometimes where the fragmentation kind of kicks in. But again, I think the ETF allows you to kind of get past that and actually invest in a basket of these companies. And I think the reality of healthcare is it can be very, very volatile, and we've seen that. And so I think that's where, again, for many investors, the ability to take on through an ETF kind of a basket approach to across pan-European healthcare for what is happening today and what may happen tomorrow is actually is quite attractive. And particularly as we think about the potential for countries to bring back some of the healthcare, not just in terms of things like research and things like that, but even the chain. I think the supply chain will be the next thing that in many countries think about. What does the supply chain look like, not just research and innovation, and therefore, as a result, what do we need to own?
Stephen, thanks so much. Stephen Cohen there, head of iShares for EMEA at BlackRock. Now, that's it for this week's Bloomberg ETF IQ Europe. We'll be back with more next Wednesday, 9:30 a.m. London time. This is Bloomberg.